In day trading, focusing entirely on profit creates a paradox. The dark reality of the markets is that the harder you chase money directly, the faster it seems to escape your grasp. Successful trading requires looking past the dollar signs to focus on the habits and systems that actually produce them. Most beginners start with a streak of luck. They catch a crypto pump or a lucky move in the tech sector and feel invincible. But without a foundation, the market eventually reclaims that capital, often leaving them in a worse position than where they started. To recover, they act like a kid in a candy store, scrolling through endless YouTube tutorials and trying every complex indicator they see. They consume hours of content, but they still don't understand the basic mechanics of how price actually moves. This leads to strategy hopping. A beginner takes 2 or 3 losses, decides the system is broken, and jumps to the next trend. It is like trying to learn Spanish, French, and German all in the same week. You constantly start over and never gain proficiency in any of them. In this cycle, they skip the basic, boring fundamentals to chase advanced, complicated setups. When these trades fail, they can't even identify the mistake, leaving them convinced that they are bad at trading or that the entire market is a scam. Repeated failure is rarely about a lack of talent. It is the result of relying on gut instinct instead of a repeatable process. To stay in this business, you have to trade your intuition for a strict mechanical system. Before applying a strategy, you have to read the basic visual language of the charts. A green candlestick indicates price moved up during that specific time frame, while a red candlestick shows it moved down. The anatomy is simple. The solid body tells you where the market opened and closed. Those thin lines on the ends, the wicks, represent the highest and lowest prices reached during that period before the market pulled back. These candles eventually form levels of support and resistance. Think of support as a floor where price finds a base to move upward, and resistance as a ceiling that prevents price from climbing higher. Mastering these levels allows you to stop guessing. Instead of reacting to every minor flicker on the screen, you can logically anticipate where the most significant breakout opportunities will originate. To trade these breakouts effectively, you need a mechanical strategy with binary rules. Either the setup meets your criteria or it doesn't. This eliminates the gray area where emotional misinterpretation and human error live. The first step is anchored to the clock. We wait for the New York market open at 9:30 a.m. Eastern Time and immediately mark the high and the low of the very first 5-minute candle. For step 2, we drop down to a 1-minute chart. We are looking for an energetic push that carries price beyond the range we just marked. We need to see momentum, not just a slow drift past the line. We verify that momentum using a fair value gap. Look at this 3-candle sequence. There is a visible vertical gap between the wick of the first candle and the wick of the third. That empty space proves institutional players are aggressively pushing the market lower or higher. Once that third candle closes, you enter the trade. You manage your risk by placing a stop-loss order at the level of the first candle that successfully closed outside of the 5-minute range. Finally, you set your exit. You expand your profit target until you reach a 2-to-1 risk-to-reward ratio. This math means a single winning trade covers the cost of 2 losing ones. This rigid structure takes the weight off your shoulders. When you lose, you don't have to panic or question your worth. You simply acknowledge that you followed the rules of a system designed to work over a large sample size of trades. Learning the strategy is only half the battle. If you stay in a demo account too long, you risk falling into a psychological trap. Your brain knows there is no financial consequence, which means you aren't actually practicing the discipline required for real trading. However, the opposite extreme is just as dangerous. Jumping into a live market with your life savings before you've mastered your execution is a direct path to a blown account. A prop firm offers a middle ground. For a small fee, you can access a large trading account to practice real execution. This allows you to build experience with actual stakes without risking your entire personal net worth. Many traders think they have a mindset problem, but in reality, they just don't have enough data to trust their system. Mental fortitude is built by journaling every trade, tracking your entries, exits, and emotions until you have a statistical proof that your plan works. Treat your account balance as a reflection of your discipline. By ignoring daily fluctuations and prioritizing a mechanical process, you align your trading with professional standards, making long-term growth a logical result of your consistency.